All right, let's take a look at the sales forecast, and we'll do the additional inputs on this as well. I think I'm going to have to change up my draw boxes a little bit. I think I had perhaps the balance sheet on there too, but we have the cash flow yet to go through and the balance sheet, neither of which is very difficult. But the sales forecast may end up being the one that gives you as much consternation as any, just because it doesn't always necessarily fit. If that makes sense, and so sometimes we do have to do a little bit of manipulating to make it work. And if you have any particular problems with yours, let me know, and even if we got to make a phone call or something, we'll do it and get it taken care of. But the sales forecast, it gives us different products, and I have had some in the past, not so much in this class, but maybe in entrepreneurship, where we use the same template where we needed more product lines. We had to expand this, and that created some issues in terms of changing formulas around and whatnot. But you guys probably won't have that same problem. But one of the most common choices of business that we had for this semester was a coffee shop. Well, so what would you have? Well, you just have plain old coffee, right? And what's going to work here, I think, most often, almost always, when it comes to units, is just use one. There may be some exceptions to that, but probably not. If you're going to have different sized coffees, we might be able to fit all that. This could get a little more complicated. But, if you're going to have coffees and you're going to have lattes and you're going to have frappuccinos and cappuccinos and ventes and grandes, and I have no idea what the heck I'm even talking about there. But if you're going to have, that kind of stuff, you might have to kind of condense that. And so maybe I would end up here and just say I'm going to have an average coffee. A cup of coffee is going to be $1.50, and I can make that for 35 cents. Okay. There we go, and you can see it entered, coffee down here. It does say one sold, but then that gives me the opportunity to come here, and then I just have to estimate what I'm going to sell per month. I oftentimes like to break that down and say, well, per month might be kind of hard to make a guess at, but geez, per day, I don't know, regular black coffees, I'd probably sell 20 of those in a day. And on average, and I'm going to be open 6 days a week, so that's 20, times 6. That's 120 of those per week. You could probably say there's 4 weeks to a month, and that might be okay. You could also take that 120 times 52, right? And then divide that by 12. And that would give me 520 cups of coffee that I would sell. Okay. It automatically then figures out my, my total sales, my cost of goods sold. That was my 35 cents per cup. It gives me what my total margin is. So it does a lot of the work for me. And if I had a fairly steady business, I might be able to, maybe I could drag this out. I think coffee would sell better until you get to about June. Then I think coffee sales are going to slow down a little bit. So while I've used 520, maybe I'm going to only sell 15 per day then. So boy, then I got to do the math again, but 15 times 6, times 52 divided by 12, and I come up with 390. And maybe that's going to go on for the summer months through like September. That'd probably pick back up again, so I can put back in the 520. There, I've got one product done. You might take a look and say, does that kind of look realistic? Yeah, okay, maybe. And then again, I would do the same thing with, I can't type, lattes. Is that how you spell latte? Okay. And those, again, one unit, and you're probably going to sell those for like $5. They probably cost like $1.25. I have no idea. There you go. And so you just follow along and you would do the same thing. And you would do that for all your products. And again, if you have more products, if you can kind of consolidate them and do an average, that's probably going to be the easiest solution. If we have to, we can extend this worksheet a little bit. It does get a little bit complicated. You probably have to get me involved if we're going to do that, but that's fine. So see if you can consolidate them, and if not, think of all the product lines. A coffee shop might have coffee, lattes. It might have, the cups, the actual cups that they would sell, or other, maybe hats and T-shirts. I don't know what all they would sell at a coffee shop. I make my own coffee at home. Okay. The only thing you should take a look at it. Okay. It's one of those things I can kind of look at and say, I wonder how much they thought they put into this. But, it's got by default, it has a 10% growth rate for each of years 2 and 3. And that may be fine, and that's okay. I guess if you're going to leave it at that, that's fine. I'll accept that. But a lot of you, coffee shop, I think a coffee shop is going to grow a little bit slower than that. So I'm going to put in 5%. From year 1 to year 2, and maybe again just 5% for year 2 and 3. Now, certain businesses you might anticipate the growth is going to be much greater than that. Okay, maybe because you feel like you're going to start out slow, and in year 2 maybe you're going to grow 15%, in year 3 maybe 20%. Okay, so that's where you would make those types of changes, and again, usually it seems like a lot of people just leave that by default, and that always makes me think they didn't put much thought into it. So take a look at that and make some adjustments if it's appropriate for your business. Okay, then let's go to the additional inputs. And this is another one too, where a lot of people tend to leave it by default, and then in this one I can tell oftentimes for sure that maybe they haven't put a lot of thought into it. If I'm doing the coffee shop, how do people normally pay for coffee? Usually right when I give it to them, right? They either pay me cash or they give me a credit card, in which case I get paid right away, okay, or a debit card, in which case I get paid right away. I can't even imagine a situation where I would bill that out unless I were somehow supplying coffee to, the police department and they paid me every 30 days, but that would be unusual. Okay, so for this particular business, I should probably change this, and I might, just to be kind of safe, I might put 95% there. I'd put 0 from 30 to 60 and 0 from over 60, but 5% I might leave there, and allowance for bad debt. You might get the occasional person that writes you a bad check or something, right? And so you can put in that kind of an allowance, and that might make some sense. Okay, then I need to change that for the other years as well. Okay, and there I go. That makes sense. My accounts payable, this one might seem a little more realistic just the way it is. Okay, I don't usually take too hard of a look at that one because it could be realistic. I got to get back up to the accounts receivable because I just gave you one example, and the truth is different types of businesses may have different types of examples, right? That typical retail is probably going to be mostly right up front. But, retail does get here in Havre, let's take Master Sports, they get purchase orders, okay, from, and a coffee shop I suppose could, but they'll get purchase orders from a college team, maybe, or a high school team, or something like that for the purchase of some product, okay, and they might not get paid on that, for 30 days. Okay, so they might be like 80% that they figure they're going to get paid cash, the normal customer that comes in, maybe 15% here, and probably still, leave some allowance for bad debt. And they may have some more, for 60 days. A few of you are doing, like diesel automotive types of businesses, which are fairly common, and I had quite a few of those that were customers, and they tended to, their billing tended to be spread out a little bit more, and oftentimes it was because they would do work for a public entity, like a school, like a police department or a fire department or something like that, and they were good payers, but they tended to get paid, a little slower. I had one guy that had a contract with the BFIN, and he didn't get paid, he got paid over 90 days just about all the time. it was a good contract, and he eventually got paid, but they had to send the bill to Fort Worth and to Timbuktu and God knows where else, right? Okay, so think about your business and think about how you're going to get paid, and then make some adjustments there. Believe me, you'll get this back in a big hurry if your business is, more of a cash type of business, and you still have the same old percentages that were down here by default. Okay, we look down the accounts payable again. Yeah, there may be some of you where the accounts payable are going to be more upfront. I think there's a daycare. Yeah, you're probably going to pay. You're probably just going to go pick up your supplies at Walmart, right? Okay. For a lot of you, you're going to pick up your supplies and get billed. Okay. So this can certainly change. Don't get me wrong, and it'll have an effect on your cash flow, and that can be important. Maybe some of you it's going to be a mixture. You'll pick up some of your supplies and have to pay cash for them, and others you'll get billed because you'll order them and get billed. It might be 50-50. Okay. So take a look at that. Again, probably not as important maybe as this one up here. Line of credit interest rate, they have 8%. That may be a little high in today's environment, but again, that one I'm probably not going to get terribly excited about taking a look at. Desired minimum cash balance, that one you might want to change, right? Most people wouldn't want to run their account down to zero, so it wouldn't be unusual for somebody to go ahead and put in $1,000, say, okay, or $2,000 or $5,000, depending on the type of money that you're running through. Additional fixed asset purchases. Most of you will leave this blank. There will be some exceptions. And what does this mean? Well, this means that as your business goes along, and in the first year, okay, do you think at some point down here, 6 months later, maybe you're going to need to buy another vehicle? That's where you'd put it. Okay, maybe it's at the end of the year. You need to buy another vehicle, or maybe it's in the second year or the third year, or a certain piece of equipment because maybe you think you're going to add other business or whatever. Okay, different types of business, whatever the case may be, and so that's where you would add this just as a gross amount, kind of like you did on the starting point. All right, if I needed to add in year 2 a new piece of equipment for $10,000, that's all I'd have to put in there, and the program will take care of the rest of that for me. So. Okay, I can put that in and leave it. Okay, now I'll know whether you watch the video or not depending on what I see here when I click on this, because please, there are probably none of you that would have a C corporation. That would be extremely unusual for the types of businesses that you've chosen. Okay, so, and I got to give you a little bit of a background or lecture here, I guess. So, other than a C corporation, all other entities are called pass-through organizations or pass-through types of entities. And what does that mean? That means that the owners are going to be responsible for all the taxes on that business. They're going to be personally responsible for the taxes on that business. Okay? A C corporation is the only exception. Everything else is a pass-through entity, and so the owners pay all the taxes on the profit, or they get the loss advantage, maybe, that they can write off against other income, okay, in all other entities. And so, because I doubt any of you would want to form a C corporation. In our area, most small businesses are going to be LLCs or sole proprietorships or partnerships, maybe some limited partnerships. The exception is some family farms and family ranches. They get some other special treatment, I guess, tax-wise, and that's we could spend a semester talking about why, but we don't need to do that. But other than that, most small businesses are going to be that sole proprietorship or LLC or something like that. So this has to be changed to 0. Again, I'll know whether you watch the video or not because I'm emphasizing that so darn much. Please change that to 0. The other change then that I think absolutely needs to be made, and that is this. Amortization period in years, and it's amortization of startup costs. If you went back to your starting point, you had some of these, not these ones, okay, because these get depreciated, okay, but they would amortize some of these like prepaid insurance or legal and accounting fees, and you could do that. You could amortize those out over a period, which means that for tax purposes, you'd be writing them off over a longer period of time. That would typically not happen. Typically, you'd write those off in that first year. So I want you to make that, oops, those buggers. I gotta unlock it. Golly. Hopefully I can change it now here. There we go. Change that to 1. Okay. That simply means that on your income statement, they're actually going to write those startup expenses off. Again, not the fixed assets up here, but some of these operating expenses. They're going to write those off, the ones that you can write off. Advertising and promotions would be an example, supplies. They're going to write those off in that first year. Okay, so you make that change, and that's it for the additional inputs. Okay, check out the sales forecast. I'm going to go back to that for just 1 second, because the important thing there is really when you get down here, you know, you kind of get this bottom line. Is this about what I think my total sales ought to be? Yep. Is that about what I think my margin ought to be when I net out what my cost of goods sold was? Yeah. Okay. Well, one more thing. For some of you, it can be effective. There is a cost of goods sold calculator. Okay. And if you got multiple products, you might have to take this and copy it, you know, onto, you can keep it on the same sheet, but you might have to take it and copy it. And that can give you an idea that probably not necessary for most of you. This would be more in a manufacturing type of or a value-added type of enterprise. So probably won't need that, but some of you might. If you do, give me a holler. There you have it. So the sales forecast and the additional inputs. Good luck.